Mark checks his trading app. Balance, $10,000. Feels solid, feels safe. But right now, if he tried to close everything and walk away, he would not get $10,000 back. He would get less, a lot less. Somewhere between that balance number and his actual cash out value sits a second number most beginners never watch. And it is the one number that decides whether Mark survives the week. That number is called equity, and by the end of this, you will know exactly why it can sit thousands away from the balance you think you have, and why professionals check it before they check anything else. Here is the definition, plain and simple. Equity is the current, real-time value of your trading account, not the value it had this morning, not the value on your last deposit slip, the value right now, this second, because the market is moving right now, this second. Every tick up or down in price recalculates it. Balance is a fixed number sitting in a ledger until you act again. Equity is alive. It breathes with every candle that forms on the chart. Mark's $10,000 balance was frozen the moment he last closed a trade. His equity, the second he opened a new one, started moving with the market whether he was watching or not. So what actually builds that moving number? Equity has exactly two ingredients. Take your balance, the closed settled money sitting in the account, and add whatever your open positions are currently worth, up or down. That second piece is called floating profit or loss, sometimes unrealized profit or loss, because it has not been locked in yet. Balance plus floating profit or loss equals equity. That is the whole formula. And everything else here is just this formula playing out in different situations. Memorize this shape, because in about 2 minutes, it is going to explain a number that will look like it does not add up. Picture Mark on Sunday night. No trades open. His balance says 10,000. His equity also says 10,000. Exactly, to the cent, because with nothing open, there is no floating profit or loss to add or subtract. So equity and balance are identical. That is rule 1. No open positions means equity equals balance, full stop. Now Monday morning, Mark opens a long position on Eurodollar. Price dips against him almost immediately, and his floating loss reads minus $300. Watch the formula work. 10,000 balance, minus 300 floating, and his equity display now reads 9,700, moving, live, changing again on the very next candle. Pause right here. Open your own chart or a demo account. Place one small trade, and just watch that equity number breathe for 60 seconds before you come back. Here's the part beginners misunderstand. That equity number is temporary. It only turns into real, permanent balance the moment Mark actually closes the trade. Until then, it can swing back to profit, back to loss, back and forth all session, because it is tied to a market that never sits still. Quick pause. Answer this yourself before I say it out loud. Balance is $10,000. You have one open trade currently showing a floating loss of $3,000. What is your equity right now? If you said 7,000, you have the formula. That 7,000 is not locked in. It is only real if Mark closes that trade at this exact instant. One more candle either direction, and it changes again. Let's put the two side by side, so the difference is impossible to miss. Balance only counts money from positions you have already closed. It does not care what your open trades are doing right now, good or bad. Equity counts everything, including the pain or the gain still sitting open on the chart. And here's the thing that matters more than any formula. Where this gap shows up on your equity curve tells you more than the number itself. A small gap during a scalp on a calm session is normal. That same size gap sitting for 3 days on a swing trade during a news week is a completely different story. Context beats the raw number every time. And the part that actually saves your account from that second scenario is coming up next. Here's where it gets serious, and this is the whole reason this exists. A trader can carry a large, comfortable-looking balance, say $50,000, while sitting on open losses so heavy that equity has collapsed to $5,000. Same account, same balance on the screen, a completely different reality underneath it. That gap between a healthy balance and a starving equity is exactly what pulls a broker's margin call trigger, because margin calls are measured against equity, never against balance. This is the thing this whole video has been building to. The balance you're proud of can be lying to you about how close you actually are to being forced out of every position you hold. So make this number actionable, not just something you glance at. Treat a fast-shrinking equity number the way you treat any setup and needs an entry trigger, a stop, and a target. Your trigger to act is simple. The moment floating loss eats past a fixed percentage of your balance, say 5%, That is your signal to review the trade, not ignore it. Your stop is not a feeling, it's an actual stop-loss order sitting below the recent swing structure, with a little wiggle room so normal noise doesn't take you out early. Your target gets sized by risk to reward, not by hope. And say this to yourself every single time. The setup can fail. The market does not owe you a reversal. It is the stop order, not being right, that saves your equity when the trade goes wrong. Now let's hunt this live. Pull up a real-time euro-dollar candlestick chart, the same market Mark was trading. Don't look for a shape, look for the relationship. Check your account panel, find balance, find equity, and if you have anything open, watch the gap between them widen or shrink as each new candle closes on this very chart. If they're touching, you're flat or break even. If they're pulling apart, floating profit or loss is doing exactly what we described, live, in front of you. Do this every single session before you add a new position. Checking equity first is the single habit that separates people who get margin called from people who don't. Equity doesn't live alone. It connects to a small family of numbers every trader eventually has to know. Balance is the closed, settled figure. Realized profit or loss is what actually changed that balance. Unrealized, or floating, profit or loss is what's still moving on open trades. Required margin is what your broker locks up to let you hold a position. Used margin is the running total of that across everything open. And free margin is what's left over, equity minus used margin, the room you actually have to open anything new. Each one of these deserves its own full breakdown, and that's exactly where we're headed next. Let's lock in the shape of this. Equity is your balance, plus whatever your open trades are floating, up or down. With nothing open, equity and balance are the same number. The instant you open a trade, equity starts breathing, moving with every candle, and it only becomes real, permanent balance the moment you close. Watch the gap between balance and equity, not just the balance itself. A large balance sitting over a shrinking equity is exactly how accounts get margin called. Here's the rule worth writing down. Amateurs watch their balance, professionals watch their equity. Back to Mark. His $10,000 balance never moved that Monday, but his equity told the truth the whole session. And once he started watching it instead of the balance, he tightened his stop and never got surprised by a margin call again. Tell me in the comments which pair you're watching your own equity move on right now. And next, we open up that whole margin family, required margin, used margin, and free margin, starting with the number that decides how many trades you can even open at once.